Today, we will talk about index futures, which are contracts to buy or sell a financial index at a set price today, to be settled at a date in the future. Index futures are contracts that allow traders to buy or sell a financial index today, to be settled at a future date. Traders use these contracts to speculate on the direction of indexes, such as the S&P 500 and the Dow Jones Industrial Average. An index future is a legal contract that obligates traders to buy or sell a contract that is derived from a stock market index by a certain date at a predetermined price. These contracts function just like any other futures contract, giving investors the power and obligation to deliver the cash value of the contract based on an underlying index at a specified future date at an agreed-upon price. Some of the most popular index futures are based on equities, such as the S&P 500, Dow Jones, and Nasdaq 100 index. Investors can also trade futures for international markets, such as the DAX stock index and the Hang Seng index. Products may use different multiples to determine the contract price. Futures contracts don't require the buyer to put up the entire value of the contract when entering a trade. Instead, they only require the buyer to maintain a fraction of the contract amount in their account. This is called the initial margin. Index futures prices can fluctuate significantly until the contract expires, so traders must have enough money in their accounts to cover potential losses, known as the maintenance margin. Index futures are cash-settled and typically settle quarterly. Profits are determined by the difference between the entry and exit prices of the contract, while losses can occur if the market moves against the position. Traders must understand that many factors can drive market index prices, including macroeconomic conditions such as economic growth and corporate earnings. Portfolio managers often buy equity index futures as a hedge against potential losses. By selling equity index futures, they can offset potential losses in their stock positions. However, hedging also reduces profits if the hedge isn't required. Experienced traders use index futures to speculate on the direction of an index, betting on the movement of a group of assets. Index futures can replicate the effects of owning all assets in an index without having to buy individual stocks or assets. Index futures contracts operate differently from commodities futures contracts, which allow traders to buy or sell a specified amount of a commodity at an agreed-upon price on an agreed-upon date. Unlike index futures, commodities futures contracts require physical delivery if the position has not been closed out ahead of expiry. Investors can speculate on the S&P 500 by buying futures contracts. The contract value is determined by multiplying the index value by the contract price. Index futures contracts don't require investors to put up the full contract value, but they must maintain a small percentage in a brokerage account. To trade index futures, you'll need to open an account with a brokerage firm. Once your account is open, choose the index you want to trade and decide whether you want to go long or short. Be sure you keep an eye on your contract as it nears the expiration date. Index futures are generally considered a bet, not a predictor. Traders who invest in equity index futures bet or speculate on the index moving in a particular direction. Various factors can move markets, which means there is no fail-safe predictor for the market, including index futures. Index futures are neither riskier nor less risky than stocks. Their prices depend on the prices of the underlying index. The risk comes from speculative positions taken by investors who use leverage to make their trades. However, they are also used as a hedging tool, which can reduce an investor's overall risk. Here are 3 key takeaways. 1. Index futures are contracts to buy or sell a financial index at a set price today, to be settled at a date in the future. 2. Portfolio managers use index futures to hedge their equity positions against a loss in stocks. 3. Speculators can also use index futures to bet on the market's direction. Hope this would help. Thanks for watching.